If you hold a massive allocation in alternative investments, you know the drag. High-yield private credit, hedge funds, and certain private equity strategies are notoriously tax inefficient. Every year, those short-term gains in ordinary income get hit by top marginal rates. You generate substantial returns, but a huge portion is siphoned right back out to the IRS. Private placement life insurance, or PPLI, patches that leak. It bolts a life insurance death benefit and an investment portfolio into a single contract. Inside this wrapper, the structure repels annual taxes, compounding tax-deferred, and eventually passes to heirs tax-free. On paper, this is a mathematically flawless strategy. It is pitched to wealthy families constantly as the ultimate tax optimization tool. Yet the vast majority of decamillionaires who actually investigate the details end up walking away. PPLI is a highly restrictive, fragile tool. Keeping the structure legally compliant demands severe friction. In practice, it operates as an aggressive filter, rapidly screening out almost everyone who tries to use it. The initial barrier is pure eligibility. Because it is an unregistered security, buyers have to meet strict federal standards as accredited investors or qualified purchasers. The practical minimums are steep. You generally need to commit between $1 and $5 million in premiums, funded over several years. But the real choke point for most families is a tax rule known as the investor control doctrine. To maintain the tax deferral, the policyholder has to surrender control. You are legally prohibited from self-managing the trades, picking specific stocks, or directing the underlying asset manager. If the IRS decides you are actually directing the investment choices, they treat you as the owner of the assets instead of the insurance carrier. The tax deferral collapses completely, and you owe the taxes retroactively as if the insurance wrapper never even existed. Families with a net worth of $20 million or more usually built that wealth by actively controlling their investments. The requirement to hand that authority over to an independent manager and accept a purely passive role is deeply uncomfortable. When forced to choose, most affluent investors decide the theoretical tax savings are not worth forfeiting total autonomy over their own capital. This chart shows the strict diversification limits imposed by Section 817H of the tax code. To keep its tax-advantaged status, the separate account is tested quarterly. The IRS requires that no single investment can exceed 55% of the total account, with further caps on the largest holdings. This strict limit makes it mathematically impossible to do what many aggressive sales pitches suggest. You cannot wrap a single highly appreciated asset, like a large block of Founders Company stock, to hide it from taxes. The math demands a highly diversified portfolio. Then there is the cost of keeping the structure alive. You pay for the life insurance itself, plus investment management fees, legal fees to draft the complex trust structures, and ongoing quarterly compliance monitoring. This graph compares accumulated fees against actual tax savings over time. Because the upfront and ongoing maintenance costs are so high, the policy requires an incredibly long horizon. The tax-deferred compounding usually only breaks even with the fees once the timeline crosses the 10 to 15-year mark. Finally, there is the legislative risk. The Senate Finance Committee recently conducted an investigation into PPLI, labeling it a $40 billion tax shelter. They have actively proposed legislation designed to deny insurance tax treatment to these specific contracts, which would eliminate the financial benefits entirely. Navigating strict asset constraints, committing to a decade-long lockup just to break even, and holding the policy under active congressional scrutiny makes the structure highly precarious. When you run the numbers, the profile of the person who actually benefits from this is a tiny fraction of a percent. They need an 8-figure net worth, massive tax-inefficient alternative holdings, a 15-year horizon, and the willingness to completely surrender control to a third party. For everyone else, traditional financial tools solve the core problems at a fraction of the cost, with far less friction. If a family's primary goal is estate liquidity, ensuring heirs have cash to pay settlement costs, they use a guaranteed universal life policy inside an irrevocable trust. It provides the exact death benefit required, with zero diversification testing and no loss of investment control. If the goal is tax-advantaged cash value growth, a standard retail variable universal life policy offers a simplified menu of investment subaccounts. It achieves the same tax deferral without the massive legal scaffolding and private placement minimums. Financial strategy works best when you match the simplest tool to the actual problem. The internet is flooded with marketing for wealthy loopholes, but for the vast majority of affluent investors, walking away from PPLI is the smartest financial decision they can make.